Okay, so we have two people, both with the exact same amount of funds to invest. One of which uses tax loss harvesting, the other does not. They both invest in the exact same funds at the exact same time, but how does one of these end up with more money than the other? Tax loss harvesting. What is tax loss harvesting and how does it work? We'll find out by the end of this video. But before I get into it, click that like button down below and hit subscribe for more of our great content. All right, so this is a term that's thrown around that most people really don't get. Ooh, tax loss harvesting. It sounds like it could be bad, it could be good. The word tax is in it, losses, harvesting. Let's clear all that up. Tax loss harvesting is absolutely good. It is a good thing. It can save you money on future taxes by capturing investment losses and potentially reducing your tax bill. But how do we do it? Okay, so when a security in your portfolio goes down in value, meaning that the value is currently lower than what you paid for it, we might sell that security, recognize the loss, and then take the proceeds and reinvest the cash in a similar security. These losses generated can then be used to offset ordinary income or investment gains, which can lower your overall tax bill. The end result is that the portfolio risk and return are left nearly the same, so you're still take part in the upside if that investment goes back up. At Wealthfront, we look for opportunities to do this in your portfolio every single day at no cost. But wait. How can a loss be a good thing? That means you lost money, right? Well, let's take a look at an example with the two most common ETFs used for the US asset class, VTI and SCHB. We're not recommending these securities, but instead just using a simple example. All right, let's say you bought VTI for $200, and a week later, it's down to $190. It's not all that uncommon. You can leave it alone, and sure, it might be back up in the near future, or you could sell VTI, recognize $10 in losses, and then buy the other ETF, SCHB, with the $190 in proceeds. Then, if the US asset class goes back up, SCHB will provide a similar return as VTI. It's really not that much different. Expand those numbers out to hundreds of ETFs every single day, and you'll start to see where these harvested losses can really add up. All right. I get it. But how can I actually use these harvested losses? That's my question. Well, losses generated by tax loss harvesting can be used in a couple different ways, all to your benefit. You can use these losses first off to offset capital gains on investments generated anywhere, in or out of Wealthfront. But the real key here is you can use these losses to offset $3,000 in ordinary income each year potentially. Now, let's assume your ordinary income tax bracket is 30%. This means $3,000 in losses could save you an estimated $900. Bet you didn't think I was gonna say that. Think about this, $900 in savings just by simply letting Wealthfront handle this for you. So what does this mean for you? Look for a service that does tax loss harvesting every single day through software. Not just at the end of the year, or at the end of the week, or end of the month, or quarterly, like some other services out there. You know 'em. At Wealthfront, we do this along with automated rebalancing and tax-efficient dividend reinvesting for only 0.25%. If you want to dig into this more, we're going to link some additional resources for you below. As always, like, subscribe, comment. We'd love to hear from you. Thank you so much for joining. I'm Tony from Wealthfront, and we'll see you again soon. Take care.